What's up everyone, it's Marcus from Logic Effects, and today we'll be discussing the world famous global macro approach to trading. It's used by some of the most famous traders in the world, including Ray Dalio, George Soros and Paul Tudor Jones, all averaging over 20% annual returns over the past couple of decades. This is the creme-de-le-creme of trading strategies, so stay tuned, you'll want to learn this one. Also, for further reading, I've put some links in the description to some great learning material that will help you understand things far beyond this short YouTube video. So without further ado, let's get right into it. What is global macro? Well, briefly, global macro is a strategic investment approach that considers the big picture when trading currencies, commodities, and stocks. And by big picture, I'm referring to investors using macroeconomic principles like economic performance, monetary and fiscal policies, and global and political themes. And traders use all of these to try and make huge profits from their trading decisions. Now, an example of this is, let's say you were a global macro trader. You could be looking at the activity of total business revenue within the United States, exactly like our picture on the left hand side. So you're considering all these businesses as an accumulation. So we add it all together and we look at all of their revenue, all of their total sales. And if you notice that the businesses were increasing the amount of products that they were selling, you could view this as a strong signal to purchase a collection of US companies. In other words, buy US stocks and potentially invest in an index like the S&P 500, which is essentially a collection of US stocks. Alternatively, if these businesses were selling stuff at a lower price and they weren't making as much sales as they were previously, you could potentially look at a short position, and this is a bad signal for the US economy and the US stock market. So you'd look to sell US stocks. Now imagine not just doing this for business performance, but also government performance, international trade, and hundreds of other economic benchmarks, which I'll cover later on in this video. This is the essence of global macro, a method of trading the markets that has been used for decades by investment banks, and they're still using them to this day. Firms like Goldman Sachs, for example, are well known for its asset management divisions to follow the global macro style, with over 229 days out of 253 where they're making between $0 to $100 million per day, every single day, purely from their macro trading activity. Just take a look at this. This is a snapshot of Goldman's macro trading profits found on page 98 of their Form 10K. Now, Form 10K is just a financial performance report that the US publicly traded companies have to publish to abide by the SEC rules. Now, in summary, this table here, what's it showing us? Well, it's showing us the returns for 2020 and 2019 and the amount they've made here. So the brackets, they indicate negative values. That's a financing term. So a bracket around 100 here is minus 100 millions because our units are 100 millions of dollars. And then at the top here is greater than 100 millions. And these numbers here are the number of days that they've earned that amount. So this would read as Goldman Sachs have had 50 days where they've made over $100 million, and they've only had 2 days where they've lost between minus 75 and minus $100 million. So straight away, it's obvious that Goldman are making more money than they lose. They have over 50 days making over $100 million and only 2 where they lose up to $100 million. Doesn't take a rocket scientist to see that they're making a ton of money from this strategy. So another crude way to look at this would be to assume that they made, let's say, exactly 100 million on these 50 days. So instead of it being greater than, they made exactly. So we would have 50 days times 100 million, and that would be equivalent to $5 billion pretty much. Now let's assume down here that they had 2 days with $100 million of losses, not between these two numbers, just assume that it was. That would be minus 200 million maximum. The difference between those would give us a total of 4.8 billion positive profit on the extremes, completely ignoring all the data in between, just to look at the extreme values. If we included those, it would be a lot more. They've made $4.8 billion profit trading global macro for 2020. And the astounding thing is, they've increased that from 2019. If you have a look in all the years back, they've been increasing the amount of money they make. So they've been compounding their macro returns. Now, I found this to be quite a neat summary of how effective global macro can actually be when it's utilized properly. So let's see how it works and see if you can use it for yourself. Typically, the global macro trading approach is split into three main categories. You've got idea generation, optimization or filtration, and finally, risk management. Each of these serve a unique purpose in a trader's view of a security or market prior to them placing a trade. Now, within these areas, macro traders will either use two of these options: a discretionary approach to analyze the different areas, or a systematic approach. Neither one is better than the other. Many of the top investors believe both are needed to work in harmony, so you have a dual approach, they call it, or hybrid approach. So let's compare the two and see the difference. Generally, the main difference is one is required to have experience so that you can generate a professional opinion, and the other is benchmarked on predetermined rules. So you generate your ideas of rules, your optimization of rules, and risk management of rules. But discretionary traders would use opinions for all of these factors here. So it's based on their experience and what they believe is going on in the market. Now, a lot of new macro traders generally and more obviously feel more confident when they use a systematic plan until they gain those years of experience, and then they can transition slowly into a more discretionary approach. What most find is that systematic methods are great for predicting the direction of price movements, so it's great for trade ideas, a systematic approach, whereas discretionary is great for optimization and systematic here. So if we were to label these, a hybrid approach of SDS, systematic for trade ideas, discretionary for optimization, and systematic for risk management, has shown to be the most optimal way to place positions. So let's have a look at an example of how that would structure out as a trading strategy. Here is a full breakdown of each step in macro trading going left to right. We've got value, optimize, and risk on a horizontal plane now. Then below that, we've got all the details of what's included in each section, so you know exactly what you need to analyze. So let's go over the first step, which is value, and break that down for you. So the first step for any global macro trader is to discover the intrinsic value of a security, ranging from business cycle indicators to interest rates and leading surveys like the PMI index. Investors will use fundamental analysis of all 23 global economies in a systematic way. So remember, this section is S, to quickly find if a currency or a stock or a general market is worth the price it's currently trading at. You're trying to see if it's valuable or not, and whether the price is above or below that value line. By the end of this first step, you'll have a whole list of trade ideas essentially that are instructions of whether to buy or sell the asset you're analyzing. This is your watch list, essentially a systematic way of knowing which direction the price should go. It's either up or it's either down, or long or short if you're savvy with your trading jargon. So an example of this could be, let's say you're a macro investor and you want to trade GBP USD, popular forex pair, and the fundamental analysis signified that the UK economy was strong, so it's a buy signal for the British pound, but the US economy was weak, so it's a sell signal for the US dollar. Now, currencies are traded in pairs, so what that would be on the currency pair GBP USD is a long signal, where if you long or buy GBP USD, you're essentially buying the pound and selling the dollar. I've got another video covering this if you want to watch that to learn how trading currencies works. I won't go through that in this video, but if you long a currency pair, you're buying the base currency and selling the quote, and vice versa if you sell the currency pair. And that trade idea would not be entered, it would be a trade idea that's added to a list on an Excel file of potential ideas in a watch list. Now, it's important to remember that these are just ideas at the moment and not actual trades. Now, you may be thinking, Marcus, looking at all of these variables here, this seems like a lot of stuff to do every week, especially because you've got to do it 23 times, because you've got to do it all for all 23 economic regions. And you'd be right in thinking that, I'll be honest. I've tried it myself when I first started out. It's not a nice task. You've got 23 economic regions, you've got to do it weekly, and if you buy yourself, you pretty much be there 16 to 18 hours a day just to cover the bases. Now, in hedge funds, for example, they realize this. So a manager delegates one or two economies to a junior trader. So he'll have about 10 to 15 junior traders. They report back to him weekly on the assigned economies. So they only have to analyze one per week. So trying to do all 23 regions alone, basically an impossible task. Hedge funds know this. Firms know this. That's why they employ so many junior traders. It's the main reason why, if you're a retail trader, your only option is to use some sort of tool to automate this part. And then one of the benefits of a systematic approach is that you can actually program and use software to analyze these sections because there's a strict rule-based system. So a popular piece of tech that many traders use is the macro currency strength meter. Essentially does what it says on the tin. It does everything in this value column within pretty much a matter of seconds. There's a free version and a paid version available. So if you're looking to be a macro trader and you're trading by yourself, a retail trader at home, definitely worth checking out. I'll put a link in the description where there'll be more information on that. Now moving on, we go to the second step, which is optimization. So let's have a look into that. Optimization is where the macro investor will filter through their trade ideas to decide which ones are providing the best opportunity currently. This may involve forms of sentiment analysis through commitments of traders report or gauging supply and demand through technical analysis and some discretion. So for example, commitments of traders report, this guy over here, this is known as a COT report also. It's a weekly sentiment indicator that tracks and provides macro traders with important information on the positioning of hedge funds, dealers, and commercial companies, and pretty much everyone else. So what this does, in essence, it tells us of all these participants, which includes you and I and every other participant in the market, it tells us what are they buying or selling, which is really important. This allows macro investors to quickly gauge the supply or demand for a particular currency or a commodity or stock and determine whether there is enough fuel in the market to push their pre-existing trade idea in their favor. Now it's really important to wait for there to be fuel, as you don't want to be the guy who enters against the tide, enters too early, ends up taking losses before the trade actually really takes off. So you've taken an unnecessary loss by pulling the trigger too early. So this step is super important because it stops you from doing something like that. Nobody likes unfiltered coffee, and you shouldn't like unfiltered trades. So I've put a link in the description with a full free tutorial on how to use the commitments of traders report, how to use the technology that we have, how to do it on Excel, where to source the information from the CFTC website, and pretty much how to analyze it. This will guarantee you filtering your trades much better than if you didn't use this report. And finally, this brings me on to the last section, which is risk management. Risk management is where investors minimize losses if things go wrong, which is an expectation of trading really. Sometimes things will go your way, sometimes they won't. So you need to minimize your losses if they're not going your way, and you want to maximize your return if they do go your way. So things like setting a stop loss, using volatility, to scaling into positions using a position size calculator. There are tons of ways macro investors actually manage their risk. This is arguably probably one of the most important steps, as it really does determine how much money you can make or lose. Thinking back to the Goldman example that we had earlier, where they were making over $100 million per day when they were correct, but in majority of cases, they'd only lose up to $25 million if they're wrong. That's a risk management profile of 4 to 1, because what's 100 divided by 25? That is 4. That means they're making 4 times as much when they're right than when they are wrong. A simple yet highly effective risk management strategy. So as long as Goldman are right over 25% of the time, so 25% of the time, as long as they're making 100 million 25% of the time, doesn't matter how many times they lose now with this risk profile, they'll be good to go. This is why risk management is super important. Some people believe you need to be right all the time to make money, and that's just simply not the case, and Goldman Sachs are living proof of that. This is really a game of stacking the odds in your favor, and if you execute risk management correctly, you'll do just that. So if you're looking to get on top of your risk management game, put a few links in the description also to some risk management tools and tutorials that will help you right out. And that pretty much concludes everything about global macro. So let's summarize with a few pros and cons and some macro tips and tricks. Like with any investment strategy, global macro isn't perfect. It has its strengths and it has its weaknesses. Depending upon the market conditions, the resources available to the investor, the performance may vary drastically. Here I've listed a few of those pros and cons so you're aware of them before you go out and use this. Let's go over the left hand side of the table first. First thing, global macro identifies long-term trends in the market. It does this because it includes all the fundamental analysis of all the reports in an economy that actually drive the price of its currency or commodity. So it's really important that when you're analyzing currency pairs, for example, You look at everything that's driving its price, and global macro is really good at doing something like that. The second thing is it's actually very adaptable to market conditions. It's got a mix of systematic and discretionary approaches. It allows you to go both long and short, and it allows you to capitalize on any market movement no matter what. So as long as you're doing your research and you optimize correctly, you'll be able to capitalize every day if you're looking in the right direction. The next thing, it incorporates fundamental, technical, and sentiment analysis. This is great because now you got a multi-dimensional look on the market. You're not just using technical, you're not just using fundamental, you're not just using sentiment. You're using all three to get a holistic three-dimensional look, and this will help you sort of keep track of what's going on and make sure you don't get blindsided by any unexpected results or black swan events. And finally, it has one of the strongest track records of any trading strategy out there. It's used by the top investors in the world like Ray Dalio. Pretty much every investment banker uses this approach, so the track record is really something to live by. It's one of the massive benefits. Now let's go over to the bad side, which is quite a big issue. With all of this comes a hell of a lot of research and tons of number crunching. It's absolutely not for the faint of heart, and it's difficult to do as a standalone trader because usually you need a team of people to execute a strategy like this. The data fees alone can exceed monthly subscriptions of $2,000 for Bloomberg terminal, for example. So unless you have over $100,000 to trade with, it's a very tough ask to be a global macro trader. And this is why at LogicFX we provide tools to save you time and research and have a team of analysts at your disposal that will help you with your global macro needs at a much lower cost. Our model pretty much is based on helping retail traders keep the costs low so that we can help you without hindering the effectiveness of research and give you the approach of global macro. So really, with the right resources, there's no clear downside to trading in this way. It just makes sense if you're willing to put the work in and find providers where you can save time when needs be. And that brings me on to the final points and tips to take home from this video. For individual investors seeking to profit from a successful trading strategy, the global macro approach may be the best option. Global macro trading goes far beyond just technical analysis or price action, delves much deeper into the securities or markets behavior behind the scenes, which is really important. And with that said, here are our recommended steps to get started if you're a complete beginner. First things first, you want to find a course or book that contains a strategy that appeals to you. I've put a link in the description to our beginner's course and a free 2-hour lesson on global macro. This is an absolutely great starting point if you're a beginner. The second thing is, you want to spend at least 3 to 6 months learning all aspects of the strategy before risking any of your capital. It's no good just learning a little bit, then expecting to make a little bit. Unfortunately, trading just doesn't work like that. You need to learn everything before you can risk any of your capital. Then once you're comfortable, it's wise to open a trading account. The third thing is have a set plan for generating your trade ideas. Use economic reports, use tools like the macrocurrency strength meter. Make sure you've got a defensible reason of why you think a trade or currency price or a commodity price should go in a certain direction. The next thing is you want to find a way to time your trade entries. COT report, technical analysis, your discretion on political themes. These are all great ways to know when to time your trades. Then once you've got a trade, you want to manage the risk. You want to make sure that you want to prevent unwarranted losses. You want to use things like the ATR stop loss calculator. You want to be able to have a risk profile at least 1 to 4 or 4 to 1 like Goldman Sachs, so that you can be correct just 25% of the time, so the odds are in your favor. That's really important. And then finally, once you've done all of that, find ways to save time. You want to be comfortable. You don't want to be churning away 18 hours a day. Find resources that are doing things that you don't need to do yourself in a way. Make sure you verify the information. Make sure they're using methods that you agree with. Save time on your research. Reduce your workload. And with that said, that concludes our breakdown of global macro. Please drop a like and subscribe for more tips and discussion around the financial world. And keep tuned for our next video. Also, if you'd like to know more about where I source the information, tons of stuff in the description, as I've repeatedly said through this video. That's all, folks. Till next time, Marcus from LogicFX.